Hi, this is John Holohan, and I'll be presenting the Proactive Investment Strategy Update for Friday, December 15th. Well, in today's report, we are going to give an update on the progress made in markets and in our indicators since the last update. Shortly before the last update, we triggered in our model a confirmed up signal. It's a very significant signal in the model and indicates to us an increased probability that a wealth building opportunity is being presented, and therefore it's a good time to put unused cash to work as well as look for new leadership in the market. And as Joe reported this week, we have deployed at least partially some of the cash that was raised during tactical selling, and also have moved into what we believe to be some of the new leadership in terms of various asset classes and securities as determined by our asset class ranking system. Now, that confirmed up signal alone is a very positive development. However, it does come with some concerns. We've talked over time about the concerns on the economic front, and that our economic model has been negative for a fair amount of time now, signaling a potential recession on the horizon. So that's a concern, and we're going to have to monitor that very closely. The other thing is we had seen what we would call a lack of market breadth. In other words, a lack in terms of the number of securities, the number of stocks participating in the positive market trend. And it's our belief that to have a sustainable wealth building opportunity, the rally has to expand. It has to include an increasing number of stocks and eventually a good, healthy number of stocks participating in the rally. So we're going to look at that very closely. We have seen some improvement in some of our breadth indicators, and I will talk about that in today's report. The other favorable thing to note is just to remind everyone, this is typically what we see as a strong seasonal period in the market. So it's encouraging to see that recent signal coupled with this shift into a seasonally strong period of time historically for markets. So with that, let's move on to the dashboard. We continue to see green across the board here on the dashboard. The most recent signal that we've been discussing here is the confirming signal that triggered on November 20th of this year, so not quite a month ago. Our longer term or core indicators remain favorable. The cash comparison indicator is positive and has been for a bit. The long-term momentum indicator turned positive at the end of November, and Joe reported on that in our last report. The universe trend indicator, we have seen some improvement in the underlying chart here, so let's take a review of that. Here are the two versions of our universe trend indicator. On the left, the logarithmic version, on the right, the traditional. This is a universe chart, so it's measuring individual stocks, calculating a percentage of those on positive trends on their individual chart, and then plotting it here. As you may recall, we measure stock trends from two perspectives. One is a logarithmic price chart, which you see here on the left, and one is what we call a traditional price scale here on the right. The traditional chart tends to move a little bit quicker than the logarithmic, and this is where we actually have picked up a change for the better. This being a universe chart, it's measuring the percentage of stocks on positive trends in our somewhat short of 4,000 stock global universe. So it's a good indication of breadth, and in this case, a little bit longer term breadth. So since our last report, we've actually seen this chart reverse up. You see that rising column of X's there? That was a reversal for the better. It's a start, and we certainly want to see more follow through, but it is an encouraging sign. What it represents is roughly 10% of stocks in this global universe have shifted from negative trends to positive trends on their individual traditional scale point and figure charts. So a little bit of breadth improvement. It's the type of thing we are encouraged by. We certainly want to see more of it, but this is, let's call it a good start. Back at the dashboard, let's shift to our shorter term indicators. We call them tactical indicators. The first one is another breadth indicator. It's based on a universe of stocks, the same universe of stocks that the universe trend indicator is based on. This is a little bit of a shorter term measurement, so let's take a look at this chart. Let's just start with the description of what this chart is. We are measuring the percentage of stocks that are currently priced above their 10-week average price. So what tends to happen during steep corrections is this chart will fall as individual stocks fall below their 10-week average price. And then you can see here we've cycled from almost high risk back here over the summer, came all the way down fairly deeply into low risk. And this low here was put in during October, as well as that low before the reversal up in November. And that kind of resulted in some good follow through, little hesitation, and now more recently, some really decent momentum to the upside. In fact, we've almost cycled to high risk, so we've kind of come about full circle. So with 72% of the stocks in our universe priced above their 10-week average price, that tells us there's been some good momentum to the upside, and at least in the short run, again, this is only a 10-week measurement here, we've seen some increasing breadth in the market. We'd be better impressed in terms of the expansion of market breadth if this remained high for some period of time, and then if we were to see some confirmation from some of the longer term breadth indicators. Another observation is, this is kind of a nice pattern here in terms of, let's call it a little bit of shakeout of risk, where you see a strong move down, into low risk. So think of this as, kind of reaching an almost extreme level. So almost think of like a rubber band, stretching and then beginning to snap back. We saw an attempt here at a expansion of breadth, a little bit of a failure, and then some really nice strong follow through. So, sometimes the corrections that take place relatively deep, but with a retest or two, and take place over several weeks, those could be really good in terms of refreshing a market trend, and that could be what we've seen here. The next tactical indicator is the overbought oversold chart. Here I'm showing a 3-year graph. The black line is the MSCI All Country World Index. That's a broad index that tracks U.S. stocks and stocks from developed international, emerging international. And then from there we plot what we call the bull trend average, or in the case of a bear market, the bear trend average. And from there we draw the channels. So we look at oversold areas down here in green meaning lower risk periods to enter the market, and red up here meaning higher risk periods. Again, think of that rubber band where, when markets get extended, such as back here over the summer, sometimes those levels can't be sustained without some corrective action, and then you kind of see the rubber band stretch back this way, and all the way cycling all the way down to low risk. And then so far from there you see a nice advance coming off of that. So I chose to go with a 3-year chart here today just to put a little longer term perspective on things. All-time highs in many indices were reached in late 2020-21 and then early 2022. So stocks globally, at least as measured by the index, so far the market is actually at a bit of a loss in that 2-year period. But so far so good, very encouraging to see that strong push off the bottom. And we're beginning to see some support in terms of expansion of the breadth. And on that note, let me shift to one of our most important breadth indicator, and that's our 2 10-day chart. And what it actually is the percentage of stocks from our global universe that currently are positively sloped on their 210-day average price. So think of a 210-day moving average on a stock chart, and is it rising versus falling? So right now you can see 52% of the stocks in that universe do have positively sloped 210-day moving averages. 210 days is about 10 months in market terms, and so it's definitely a longer term measurement. So what I kind of want to highlight here is where we are with recent market action. This 50% line is very important to us in terms of the potential for either a market expansion or a market breakdown. If we just look back to last year, where we got the two global sell signals, and we see right away, very early in the year, that's one represents a January of last year, this particular indicator was dropping pretty quickly. So breadth was being sucked out of the market. Stocks were shifting from positively sloping average price lines to negatively sloping 210-day moving averages. And you could kind of see some quick acceleration once it hit that 50% point. Then a general, if you will, breakdown that kind of resulted in some of this, if you will, capitulation in the fall of last year. That ultimately led to the global buy signal that triggered on November 30th of 2022. And again, we're about 14 months into that signal right now. And so as market breadth expanded through 2023, it hit this peak here over the summer and kind of began again a pretty quick steep fall. And once we hit that 50% line, drop below it, we consider that to be our 210-day warning signal. And it tells us we really have to be on the lookout for the potential of a breakdown in the market, because it's difficult to support positive trends when a lot of individual stock charts are slipping to negatively sloped price charts. So fast forward to where we are today, that 11 represents a November reading, and that's what it looked like on the report from 2 weeks ago. And now recently, here in December, we see that it actually reversed up and popped a little bit above the prior X column. So that's a positive development here, meaning that longer-term stock participation in the market rally is expanding. But with that said, it's very important for us to see some continued positive momentum on this indicator for us to get convinced that this is going to be more of an intermediate or even longer term opportunity for wealth building. We really do need to see some of that expansion of breadth here and a movement up, continued movement up in this indicator. And next, let's check in on the Arlington Wealth Management Valuation Indicator. We have had the quarterly update completed. All the data came in. We haven't seen a lot of changes here, but let's get our bearings first. Starting with the dark blue line is the indicator itself. So our indicator is made up of a few different, let's call them sub-indicators. So a few different data readings that help us to understand if markets are overvalued versus undervalued, and importantly, what that might mean over the long term, meaning the next 10 years. And we do that by looking at the past data and periods where the indicator was at a particular reading and what performance the S&P 500 actually realized over the following 10 years. So think of it this way, these readings up here, the corresponding 10-year actual returns can be found on the blue shaded chart below. And the scale is over on the far right. So this point over here, corresponded to 250% returns in the S&P 500 in the following 10 years when the reading has been low. We think this is a useful tool to understand market potential 10 years down the road. So periods here, think of this, everybody remembers the tech bubble, right? The valuations were very high back then, and the future 10-year returns in the S&P 500 were negative. So where we kind of find, recent years, this is the value, kind of reached these highs coincident with the highs in the market back in early 2022, and then that big steep correction. And one more thing to explain, the forecast for the next 10 years, because at this point in time, there are not future 10-year returns. So you could think of this as kind of, this chart lags 10 years. And so the gold color down here, those are, if you will, forecast returns as forecast by our indicator. And so as market values have increased here in recent years, you've seen, The forecasts actually go negative a bit here. And it's kind of not important that it's, whether it's negative or positive, but at these low levels here, in terms of forecast returns, think of it as, relatively low opportunity in the S&P 500 as indicated by this model. So with the current reading, we still remain, with a forecasted negative returns over the next 10 years in the S&P 500. And that's why we feel it's important to be very diverse in the opportunities we look at. Joe mentioned in the last report our asset class ranking system, where we select investments from, is comprised of roughly 250 asset classes, and that covers everything from large, broad market indices down to very finite things, down to individual country markets, international regions. So when we get our buy signals, we look to that asset class ranking, and I like to say we don't necessarily have allegiance to any one thing. I mean, we are looking for what we believe to be the emerging leadership as measured by our asset class ranking system. And so right now you will see some international exposure. And that's not to say that we are making that decision because of forecasts like this in the S&P 500, but it just serves as a good reminder to us that longer term opportunities can come from anywhere around the globe, and could be areas of commodities, things like that, precious metals, other material sectors. Could be a lot of things that provide opportunities, even though we're not necessarily seeing longer term opportunities forecasted in the S&P 500 by this model. So to wrap things up today, maybe we're beginning to see some green shoots that are supportive of a more sustainable rally here, but it's certainly too early to call that. But the improvements in the universe trend indicator and the 210-day rising chart, those are very good developments. In the last report, Joe covered the recession warning model, which remains negative, so that's always kind of a caveat here that we think about. We do have the seasonality in our favor for a positive trend to have some level of sustainability. But again, we don't know if it's short term, intermediate term. To get convinced that it's more of a long-term opportunity, we certainly want to see those longer-term breadth indicators improve. Well, that'll do it for today's update. Thanks, and have a great weekend.